Before we start the session today, probably we would like to have a word with Mr. Umar, like why we have this PMA and PMA ETF Eq8 US Titans 50 on our platform, and what makes this product different with some other products or unit trust offerings in the market. Over to you, Mr. Umar.
Thank you. Thank you, Kim. Thanks for having me here again. We were known as i-VCAP back then when I first came, and now we've gone through rebranding exercise. We're known as Eq8 Capital. We remain a wholly owned subsidiary of Kenanga Investors. I think one of the key partners with Phillip Capital, a long-standing one. So this is a continuation of the close relations that we have with each other in the industry. And I think through this cooperation, we managed to come up with this product, which is the Phillip managed account, specifically for the Eq8 US Titans ETF, the ETF issued and managed by us. So just briefly on that note, I think before I go further into the session, I think it's important to set the context. Now, at the bottom part of the screen, you may see that Eq8 US 50, that is the acronym that we use for our Eq8 US Titans 50 ETF. That's been launched on Bursa Malaysia since 2018, denominated in US dollars. It's Sharia compliant. It's closely monitored by our Sharia advisors as well. So this ETF, with this performance, has led it to be ranked as a leader for US equity strategies in Malaysia, available to investors in Malaysia by the Lipper Leader Fund Ratings. You can look up the age, and you can see this for two categories, which is the total return and consistent return. Now, this product is listed on Bursa Malaysia. So through our discovery and through our engagement with Phillip, we've come to a conclusion that not all investors are familiar to invest on this product on the exchange, which is with a CDS account. So through the collaboration with Phillip Capital had created a managed portfolio that feeds entirely into the Eq8 US 50. So this aids the fulfillment process and the familiarity and a bit of comfort and confidence that Phillip Capital provides to his investors, as well as the distributors that's promoting the product.
Yep, that's great to know, and especially this is a Sharia compliant product, and we all know that ETF is an untapped market, so there is a lot of potential for that. And we all know that ETF is known as it values passive investing, basically. Would you like to share more on passive investing?
Yeah, well, I think there's a very, very key tenet of the product, the nature of the product. So, because mostly in Malaysia now, we have a breadth of active investing styles that are deployed by active fund managers. And we've seen, the growth of active investing in other markets, whereby the growth or the inflows of funds towards active investing in America, for example, has overtaken active management. So passive management is gaining a place in the market. Its growth has already matched cross against the assets is managed on the active style. But then comes the question is, what is the difference between the two, right? So you have your active investing where typically you have a fund manager. Some are doing it via robots nowadays. But imagine that you have a fund manager who has conviction, who has a view of, based on the strategy that they wish to deploy, that based on this view that they will form a portfolio and with an identified index that it wishes to outperform. So these managers will then, continuously manage the fund, picking stocks and having certain views, whether it's growth or whether it's meant for dividends and all that. So as opposed to a passive investing approach, passive investing at the inception of an ETF, the index is selected. So we pick an index and we feel that this is the index that we want to track. So the difference is active management wants to beat the index, passive management wants to track, it replicates, it copies identically of what the index provider states. Right? For example, our product we're using, we use S&P Global, or even Dow Jones for that matter to come up, MSCI. These are a couple of very, very high profile index provider that, based on historical data and statistics, they form rules. Okay, like for us, it will be the top 50 counters, and it has to go through Sharia filtration. Top 50 counters by market cap. Do we only do one exchange? No, we do all exchanges available in America. So we take the best of the 50 counters in America, and we bundle it and unitize it to become an instrument for ETF to make it accessible to the investors.
Yeah. So we all know that active managers that seek for outperformance by a certain margin, say 300 basis point or maybe 500 basis point above the benchmark, things like that. But passive investing, most of the times you can only move along the benchmark that's set. So is there any possibility where passive investing could have outperform active managers at times?
Yeah. Fair point. Fair question. Before we go into that, just briefly, the assets count was mentioned earlier that it has already matched the asset of actively managed assets against passive assets. Now, I'll come back to this slide, just to address the question by Kim. Now, how often does active versus passive how do they fare against each other? Now, this for the purpose of this slide, because our product, the ETF feeds into it's an ETF that focuses on the US sector. So we're looking on the US context. I think it's very important that we put it into the same frame of things. Now, on a 12-month rolling basis in the US, this is a statistic that we've obtained from those sources, Investment Global and Morningstar, for large caps, specifically for large caps, right? I'm focusing on this because our product is the top 50 counters. So it's not even top 500 of the S&P 5. We've taken like top 10% of that.
Yeah.
So for the US large cap, 38% of the time, only 38% of the time, active managers have outperformed passive strategies. So we are in a good place in a highly efficient market in the States that passive investing, it is a very, very viable option as compared, against active management. Neither, we are not saying one is better than the other, but it is a viable strategy that investors can look at in deploying and forming its portfolio. So especially in the large cap sector. However, when you look at emerging markets or international developed, the numbers may differ.
Yeah.
Right. So this works in the US.
Efficient market.
In efficient markets, yeah. Okay. So and we have this concern, right? Index investing is it because we are copying, we are replicating. But what we are replicating is not static.
Yeah.
You may be top 50 today, you may drop your position.
The benchmark may change over time.
It changes over time. So we do rebalancing every 3 months. So what happens during rebalancing? During rebalancing, the composition may change. So what we're showing to you today in front of the screen is a difference of the constituent over a 10-year period, 2013 to 2023, how things have changed. Right. So you can see on the right, this is where we are at mostly in 2023, that there are this is just merely the top 10, yeah? We're not even looking at the top 50 yet.
Yep.
Right? So at the top 10 level itself, you have 1, 2, 3, 4, 5, 6 counters that were not in the top 10 in 2013. Right? And you have change in dominance, change in shift in terms of companies. You look at Microsoft was the 4th largest constituent. Not to say that they are the 4th best performing or not. This is in terms of the weightage of the funds. Typically, in the index investing world, the top 10 counters would typically make up 50% of the total constituents. So you have if you add up all their holdings for the ETF, it comes out to about 50%. So now Microsoft have gained a rank. You see more oil and gas companies over here. IBM is there. Now IBM is nowhere to be seen in the top 10. So it shifts, it goes to rebalancing based on industries. 10 years ago, if we were to bring this back to the 1980s, for example, you see, 7 out of the 10 constituents are oil and gas companies.
Yeah.
So it shifts with the industrial revolution. So with data, not based on conviction, just purely based on data and ranking and the filtration process, this is the constituent.
So when the economy is changing, the benchmark will also reflect the changes as well.
Yeah, accordingly.
And as we can see, the top 10 companies 10 years ago may not be the same 10 years later, and the weightage may be different as well. So now we have already touched on passive investing. We have also we also make to understand that the index actually evolves with time, things like that. would like to share more on how Eq8 US 50 adopt those changes or those, ultimately whatever that we show here is just in practice. So how do we put this in practice for Eq8 US 50?
Okay, fair point. I mean, it happens at behind the scenes. So as an investor, or as a distributor, as a salesperson for this is a process that happens at the fund manager level. So every quarter we will do rebalancing. So sometimes rebalancing can be significant, sometimes they're just minor. So there could be a change in maybe 0.5% in holdings for Microsoft, an increase of the darling of the market now, Nvidia, which never existed 10 years ago. They probably don't even make the top 50 cut 10 years ago. Right now, they are the darling for market, they are number 4. So all this rebalancing happens at the fund manager level. So how does it affect you? It does not affect the investor. The investor will just enjoy the process and get reflected in terms of the returns of the product. So that's where the role of the fund manager in managing it efficiently, where you as an investor, you get the diversification access across all of the continuously top 50 companies with Shara filtration. Right, so that's where the process of rebalancing occurs, and it is also passive. As much as passive for us because we're replicating. You will take on a passive role as well.
So if you notice, actually Mr. Umar keep on repeating words like Shara compliant. I think Shara has been getting a lot of significance of late, and he also mentioned about rebalancing. So the management style can be very dynamic as long as it replicates the index. Then this is how we actually manage the fund. So would you like to share more on how has this fund actually performed over the past years?
Okay. Yeah, we keep mentioning Sharia, and I think that is quite a key element in terms of the product and its viability and its access to investors. Now, because through Phillip, through this managed portfolio of PMAR, where you can access your ETF investments at an amount that is permissible for you to invest in this product. So now we have conventional accounts, we have ETF accounts as well. So if you hold an ETF Sharia account, you would have access to this. So had this been a pure conventional product, then the access will be limited and will not be able to get to the ETF investors with Sharia account will not be able to invest in this. So now on that note, we are looking what you see on your screens right now is the performance of the product. Okay, so we launched in 2018, so it's been a good 5 or 6 years since we've been in existence. Now, what you see that our product is quoted in US dollars, and the figure that people are seeing on the exchange as well, they're settling in US dollars. After being, your broker will convert it to ringgit value for you to ease your settlement process. Now, year to date, we are at 15.3%. Okay, now the market is very vibrant at the moment. The Malaysian market as well is moving. It's taking a very, very great stride. So we what we prefer to do is whilst the year-to-date performance is healthy, we like to look at the long-term returns. So it could be just a blip of a year of a performance. So, okay, let's extrapolate that and look at the 5-year returns. Our 5-year returns are 145%. Now, coming back to the point of what it is quoted in US dollars. So what does that do? Naturally, a forex risk comes into play. Now, that means you will be exposed to the ringgit and a US dollar pair. Okay, so as you're exposed to the ringgit and US dollar pair, the performance of the US dollar will have an impact onto you. Now, the ringgit movement against the US dollar has shifted by 30%. So you can see that. So for the ease of our comprehension, we've added in the factor of the ringgit element here. So your net returns, had you invested in the product, which your source of funds has always been in ringgit, would then translate to an additional 30% over the 5-year period.
So I think what is interesting here is that we have seen the vibrancy of the US market, and the fund has actually moved along the index itself as well. And what more, because of the ringgit movement, right? For the past 5 years, we have depreciated against US dollar. So that has also added some currency return into the fund performance itself. Would you also like to compare like how has this Eq8 US 50 performed against some of its peers in the market?
Okay. So I think it's very important that we remain within the strategies that we deploy. So because we have a US strategy, it's only fair that we compare our performance against other US strategies available. We are the only ETF in Malaysia that has a US strategy.
Yep.
And
it's Shara
and
compliant.
Shara as well, and these are the performance returns taking into account as well with the ringgit element. Because for ease of comparison against other funds available, that they are also quoted in so that our comparison is at the same rank with ringgit values. We are with most of these funds have some have active strategies, mostly have active strategies. And this is our returns against some of the peers that funds available in Malaysia deploying US strategies, active and passive, as well.
So it can also be comparable against some other active funds managed by other competitors as well. So would you also like to share like because we all understand the concept of state investor, dollar cost averaging, things like that. We all know that the market movement can be very volatile, right? It goes up and down, things like that. But over the long term, we have seen US market has demonstrated resilience, things like that. Over the past 5 years, I think, or even past 10 years, it has registered some strong return, analyzed return, things like that. So if we were to invest like probably an amount of 10,000 probably few years ago, like what would we have gotten like today?
Okay, so the beauty of the passive investment, what you see on your screen right now is a very strict behavioral pattern that was deployed by an investor. Okay, so this calculator shows that the investor decided to commit initial subscription of 10,000 ringgit. Okay, and with great discipline of investing every quarter to achieve dollar cost averaging. Maybe the access to funds is every quarter. For example, your EPF redemption also is, you're operating on a 3-month period. But this could be done on a monthly or even fortnightly for that matter. You can invest 26 times in a year if you do it every 2 weeks. Now, for this purpose of simulation, what we're trying to say that the discipline has been deployed. One, taking away any emotions in terms of having a view of the market. That is what we're trying to exemplify here, with dollar cost averaging. And this is a strategy that works best with index and passive investing. Because as the product does not have any emotions to it, there's no convictions in terms of, I would like to have this stock in my portfolio. No, because we are replicating the index. So at the product level, there's no emotions. So it's very important that the investors also take on a non-emotive approach in terms of investing. Because yes, the numbers looks very healthy. You put in a total capital of 100,000 and we come up with 202,000 after 5 years. But this is historical results. I think it's very important that we make that disclaimer. Once, we love this chart, we would love to have this kind of returns. But we wouldn't have known that COVID would have happened. The impact of COVID would have been there. We wouldn't have known that in 2022 that the American market, the S&P closing, our product closed at -20%.
Because of the high interest rate.
Correct, because of the interest rate. We wouldn't have known that last year that the product would perform very healthily at 40%. So by de-risking yourself through regular investing, taking out the emotions, match the product characteristics, it would be the best possible approach to deploy when you have a passive fund in your portfolio.
I think Mr. Umar rightfully pointed out that as a fund manager, as an investor, it's very, very difficult to take up emotions from our investment journey. But somehow, by investing into ETF, we can actually sort of eliminate the emotions element from that. And most importantly, ETF itself is a passive investing. And now with the dollar cost averaging, right? investors could potentially capture the downside and upside of the market, right? So regardless of the market condition, as long as investors stay invested, then probably investors can achieve a optimal risk-adjusted return over the long term. Would you also like to share on how this Dow Jones Islamic US Titans 50 index has performed against some of the major benchmarks like your S&P 500 or even MSCI World?
Yeah. Okay. In the investing world, a 5-year-old product has been said to be still a young product.
Yeah.
So maybe one will say that, okay, last 5 years has been great for you, but you've only existed for 5 years.
Yeah.
So in terms of the longevity, let's track back by another 20 years. Okay, now the index has been around for 30 years. Remember, we are replicating the index. So our returns is meant to look identical to the index. Now, so what we wanted to do here is we wanted to show that, okay, maybe 5 years was fluke, the recent 5 years. Now we pull it back to 2003. And we want to compare ourselves with the S&P 500 index. Mind you, S&P 500 index is a superior reference point.
Yeah.
Okay, because this is the index that's given you an average of 9 to 10% returns over the past 40, 50 years to various industrial revolutions. So we want to compare ourselves against that. Now, we took a 20-year growth and compare us against the S&P 5. Now, would it be based on my skill as a manager for this year? No. Because we had picked the right index. That's all, right? So we aren't going to stake claim in terms of that conviction because it is essentially a passive product. Now, with this, you can see that a 20-year return of 600% against the S&P, which is a very, very superior index of 472. There are others who also view, hey, let's compare this with the world and reduce the concentration of just a US-centric strategy, and you have 317%. Even though one can argue from another point of view of looking at S&P 5 index, as it is 80% globally represented. The counters as listed there have global presence as well, right? So you can see that even during, look at 2015 onwards, right? 2015 onwards is when you start to see the divergence occurring. Okay, and are we taking much more risk? Is the index more exposed to risk during down markets? No. When COVID hit, they took the same amount of beating. But when during up markets, it is diverging. It is diverging from the MSCI World Index, it's diverging from the S&P 5. And during down markets as well, it's not doing far worse. It's tracking down the same way. Then comes after 2022, the uptick starts coming up. And the divergence is happening again. So I think that's where the key separation have occurred in the past 10 years.
So if investors are looking for Sharia compliant product, US strategy, things like that, I think this is actually a best fit. But of course, a disclaimer here to be made is that past performance doesn't guarantee future returns. But of course, we would also like to remind investors that the risk that the market risk, currency risk, things like that. But of course, we all know that as long as the market, is an efficient market, it demonstrates resilience. The policies are right. The economy is growing. Earnings growth, companies' earnings are growing as well. Of course, there are years of ups. There are also some years that we can see some drawdown as well. Probably over the next slide, maybe Mr. Umar, would you like to share how has this fund actually performed over the past 20 years by the calendar year return?
Okay, so on that point, we do have certain trend slides that we want to talk about. We'll touch a bit on the rate cards. We'll touch a bit on election in a bit once we are done with this section. So now we're going back, right? This is it's similar to the previous slide, but what we've done is we've presented in this manner to show you that how does a market move. There will be downside markets.
Yes, definitely.
There will be dips. There will be 2008 is not even a dip. We can call it a crash. Right. And the last one was the 2018 and 2022 where the effects of the interest rate took onto the market. So on a 20-year return, returns. And this is what you've seen based on the index that we are tracking, right? The 10-year average is 13.4 and 9.6 for a 20-year average.
Yeah.
With a total of a 21-year period, we had 3 down years and 18 years of up years. So there will be dips. The question is, how fast is the recovery?
Yeah.
Right? And if you remain to have the conviction in your behavior, not in conviction in your views, you will receive healthy returns of like 9.6% over 20 years.
Yeah. So basically, investment is not zero risk, right? In some years, like what Mr. Umar has mentioned earlier, in some years we'll see some drawdown of even 30% in 2008. Even back in 2022, we see 27% negative returns because of the, like we mentioned earlier, the high interest rate in the US. Probably on top of that, we also have Ukraine-Russia war, things like that. So that has caused the market performance, the lackluster market performance. But of course, like what Mr. Umar pointed out earlier, what matters most is that how the market can quickly recover from its bottom. So probably before we open up to Q&A, probably Mr. Umar can share some of the outlooks and trends in the US market that you think it's interesting and it's worthwhile to share with the audience.
Thank you. So yeah, outlook and trends, for us as passive managers, it is one of those things that we look at. It does not affect us in terms of the composition of the product, because the composition of the product remains, you're meant to track it. Yeah, we have to do exactly as what the index says.
Yeah.
In up markets and in down markets. So we do not hold any view.
Yep.
In terms of our daily management of the funds, when it comes to what will happen when election year, or what will happen when interest rate cuts, because look, we are passively product.
Yep.
Follow the rules setting is there, there's no emotions. This is the process. Okay, so now it is unfortunate that there was an assassination attack on one of the candidates, President Trump. We do not wish for anything bad untoward to happen to anyone on that facet. But there is always that buzz to talk, what happened during election year. So we felt that, we went looking around. We found this very interesting statistic. Now, the American political system, it has a White House control and it also has Congress, right? So there's a mix and match between Democrats and Republicans, as you see here, and there's whether the outcome is a one party or whether it's a divided, it's a mix of both, or is it a 1.5? So this is half and half, 1.5, 3.5 against 3/4, or you get a full Democrat, full Republican outcome here. So what we've seen is that how significant, on the last column here, how significant of this outcome. And this is a significant outcome is exemplified when the effects has got more than 95%. It's that level of significant outcome. So what we have seen through data is that the significant outcome of the mix on the outcome of the election results do not have a very strong bearing onto the market, which translates onto the portfolio returns, right? But what we've discovered instead is that the historical and economic data, all this economic data, inflation, all the fiscal policies and all, would have a stronger impact onto the investment of the investment returns, or even the index for that matter. So therefore, our suggestion, our recommendation is just look at the historic and economic data rather than the election results, because that has more bearing rather than the outcome of the election.
It seems that the economic environment indicators are more important than the election outcome from the observation. So perhaps maybe we can also talk about the Fed funds rate and the market performance. How are they actually correlated?
Okay. So yeah, that was the second. That is always the guessing game, right? We started the year with a call. The call of the census of the market was there was going to be 6 federal rate cuts this year, and there's been none. To this day. So the latest call is there's going to be 1 cut in 2024. With a forecasted of 2025, 4 cuts in 2025. So you see the Fed rates being increasing over here. right? And and how does that impact some of the constituents, right? You can see like on this page, right? So what happened in 2022 and what happened in 2023? So if you call 2022, our product performed at about -22%.
Yep.
And in 2023, it returned close to 40%, 39.9% for the Eq8 US 50.
Yep.
Now, the explanation that one of the explanation was that when interest rate first went up higher, it affected the large stock companies because they are including very growth stock, tech growth oriented stocks. It affected the returns. So you can see dark light blue here is the S&P 500 companies growth. And Russell 200 is the growth that looks at the top 2,000 companies on the index. So it factors in the medium and small cap companies, right? Now, however, the rate had carried through all the way to 2023, and it was even increasing at some point in the earlier parts of 2023. So even at the peak interest rate levels, the impact has suddenly shifted to the smaller companies. You can see that the smaller companies are facing this impact, predominantly one because the larger companies are not affected because they have issued longer term debts at favorable dates, favorable rates. The smaller companies will be borrowing, and they are borrowing at these higher rates. So therefore, the growth were affected in 2023, right? And this is carried through. The effect has been depleted a bit in 2024, and you can see that the sensitivity of the large cap companies remain the same for 2023. They are not really that affected by these rate cuts.
Yep. And hence the for Eq8 50 that we are investing in majority of the companies are large companies, right? So not so affected by this scenario. So we are happy to take any questions from the floor, right? If there's any. Okay, from the live, we actually got one questions from the audience. Probably not sure whether it's the right question to ask here, because we just now we talk about passive investing, we talk about taking out emotions, things like that. But perhaps Mr. Umar can also share your view on the emergence of China competing against the US for world's economic dominance and the pickup on the de-dollarization movement. So how would that actually affect the Eq8 Dow Jones 50 product?
Okay. Very interesting question. You're bringing China into the fray. We've always loved China. We speak to my colleagues in the office, the active fund managers. Everyone is very optimistic in the view of China. Now, and then we look at the growth of China companies. Some say that buy a BYD instead of Tesla. They perform better on that front. But what the view that we form is this: it's not so much of just the US economy. It is just in terms of the dominance of when will we have a greater dominance of China in terms of services, in terms of value, in terms of deliverable onto the industries of the world, spreading across various facets of things. Now, we don't look at our product purely as a US trade. Like I mentioned earlier, right? These companies are listed in US. You can buy, one great example is this: you can buy US listed ETF that
invest in
Malaysia,
Malaysian
index. There is an FBM ETF in the States. So when we talk about listed products in America, it is where it is domiciled. Right? When you talk about listed strategies, it is where it is domiciled. It's not so much that their business is so ultimately sensitive towards the American context, because Google is everywhere, Facebook is everywhere in your phones, Meta, the whole group. And the industries reaches far and wide globally. So in that sense, I think if you have a view on China, it is a healthy view. There's always a matter of timing. We've had in the past that the markets have been overpriced in China, and we also took a downturn for a bit. But I would say, you know, do not discount looking at China.
Yeah.
Yeah.
Yeah. So we have another question on you know, US 50 Titans, whether we can expect the performance of this US 50 Titans will reflect the Dow Jones performance, Dow Jones Islamic Index performance. I guess the answer is yes, because we are actually, you know, tracking the performance, reducing the tracking error. Is that
Correct.
so?
Yeah, a very good question, a good technical one. We can get to a bit of technical stat here. Our tracking error is now 0.3%. You know, there's various concerns about this. Sorry, the various causes for this, you know, timing, time difference, slippage in forex rates and all. But it's not a significant amount. You know, we are still operating within the boundaries of what's been stipulated in our prospectus. So it will reflect. So we compare ourselves against other index, for example, other Islamic index and other conventional index, and we've seen that, you know, by the grace of a good decision that was made to choose this index, that we have seen that our product seems to have outperformed. This largely, you know, the outperform of S&P 5 is very simple. It's because we have coverage in NASDAQ. Our counters are, we have tech stocks, so that's where our outperformance is coming from the index, right? And also that additional counter on BAT, another exchange. So yeah, do we see it getting better? You know, it's human nature, right? You know, the market is performing really well, and there's concerns. Oh, is the market too hot? And when the market was on a downtrend, oh, is it going to go down lower? So, you know, we've shown in the last slide and for a couple of slides ago that you know, you need to emulate the strictness of removing the emotion when it comes to index investing. That seems to have worked very, very well.
Yeah. So I think the answer to your question is that yes, it will exactly, you know, follow the performance of the benchmark itself, right? If not, the tracking error could be minute. It's just probably 0.3% that Mr. Umar mentioned earlier. Another question from the floor is that what is the year-to-date performance of US 50 Titans? I think we have a slide over
Yeah, we do have that. What is that?
Yep.
Yeah, you can look at this one. Yep, the fund performs at what, 15.3% in US dollar terms, and if you were to put in the ringgit element, I mean, it comes down to when you put in your ringgit though. Yeah. So you know, so look at the USD figure.
Yeah. Yeah. So ultimately, it's also very, very important to, you know, talk about diversification, right? Apart from having exposure in, you know, even back home Malaysia market, Asian market, I think an addition into a US you know, product in your portfolio is also vital. Is that right?
Yeah, it is right. It is right. So I mean, we are in Malaysia, right? You may have 100% Malaysian portfolio. You may have a 60-40 Malaysia non-Malaysian portfolio. So you know, you even may have, you know, the most common figure that's being thrown around is between 2 to 5% in crypto, for that matter. Yeah. Right. I mean, this is not investment advice, just to qualify myself. But you find a place, look at your risk, look at your appetite, and see that where you want to deploy your funds, I suppose. And this can be, it could be just for general investing, it could be just for retirement planning. So it comes down to where are you in the phase of life, you know, as what we've been taught in the financial planning school, and also the risk levels that you wish to take.
All right. So basically, of course, the past performance is very, very impressive. It also doesn't guarantee any future performance, but as long as the economic indicators in the US is favorable, the inflation outlook, interest rate trends are also moving along the market expectation, I think this Eq8 US 50 will continue to register some optimal risk-adjusted return over the long term. Right. So before we welcome any last question from floor, allow me to also quote a research report done by our sister company, right? Phillip Research Kenanga Berhad. So basically, this report is available on our Phillip Capital platform as well as our Bursa Marketplace. So quoting this research done by Phillip Research, we have a buy rating on Eq8 Dow Jones US Titans 50 ETF with a target price of $3.15. We raised our target price of $2.80 earlier because of the encouraging outlook in the US market, encouraging economic data, right? And the market is also expecting the Fed to keep the door open to a September rate cut, things like that. And finally, we are also seeing some potential catalysts which include better than expected disinflationary data, which will also prompt rate cuts as early as September 2024. And recently, we also see that the real GDP growth forecast by the Fed has remained at 2.1% for 2024, attributable to solid economic data. So all these positive factors have also shaped the potential upside of this Eq8 Dow Jones US Titans 50. Right. I couldn't see any question from the floor, and perhaps I think it's a very it's also I think we are okay to conclude the session. Thank you so much to the audience. Thank you so much to the participants for dialing into our session today. If you have any questions on Phillip managed account on this Eq8 Dow Jones US Titans 50, you are always welcome to reach out to our customer service at cse@phillipcapital.com.my. You can also reach out to our value distributor to know further information on this product. That's all for today. Thank you for dialing in. Stay tuned for our next Phillip Mastermind. Thank you to Mr. Umar as well for being our distinguished speaker today. And we hope to see you guys soon, next month. Thank you so much. Thank you.
Thank you, Kim.
All right.